Assalamualaikum warahmatullahi wabarakatuh and good day to everyone. My name is Muhammad Muaz bin Warasdi, and today I want to present about the description of advisory service, which is financial due diligence. I also explain about the understanding on the advisory service and regulatory framework in Malaysia related to the advisory service, and also the professional skills in advisory practice. The financial due diligence is a detailed review of a company's financial health. It is usually conducted before important decisions such as merge, acquisitions, or investment. The main purpose is to identify any risks and opportunities within the company, and by doing this, it helps investors or buyers make better and more informed business decisions. Next, I will explain the tasks performed during this advisory service. The first task is reviewing financial statements. This includes analyzing the income statements, balance sheets, and cash flow statements to understand the company's performance. The second task is to identify hidden liabilities and risks. Sometimes companies may have obligations that are not clearly shown, such as unpaid expenses or legal issues. The third task is evaluating the quality of earnings. This means we assess whether the company's profits are sustainable or just temporary, for example, due to one-time gains. Finally, we provide recommendations to clients. Based on our analysis, we advise whether the investment is good, risky, or needs further considerations. During this process, we also learn about how evaluations works, which is very important in decision making. For the valuation, there are three main types that are commonly used. The first valuation is based on the future earnings, also known as discounted cash flow or DCF. This method estimates the company's future cash flows and then discount them to present value. It focuses on the company's future potentials. The second is net tangible assets or NTA. This is an asset-based valuation method. It calculates the company's values based on its assets minus liabilities. This reflects the company's current financial positions. The third is market comparable, also known as the price to earnings ratio, which is PE. This method compares the company with similar companies in the market. It reflects how the market values the company. Next, let's look at the report produced from financial due diligence. The first part is the executive summary. This provides a brief overview of the key findings and overall conclusions. The second part is the key financial findings. Here we highlight the important insight from the financial analysis, such as profitability, cash flow, and financial positions. The third part is red flags and risks. This includes any warning signs identification during the review, such as hidden liabilities, unusual transactions, or unstable earnings. We also examine legal and tax issues, for example, potential legal disputes or unpaid taxes that may affect the company's value. Finally, we provide recommendations to clients. These recommendations help clients decide whether to proceed, negotiate, or reject the deal. Now, I will explain the key regulations involved in advisory service in Malaysia. First is the Security Commission Malaysia. This body regulates merge, acquisition, and takeover under the Capital Markets and Services Act. Next is Companies Act 2016. This act focuses on directors' duties and ensures proper financial reporting covered by the companies. And last, we have Bursa Malaysia. It sets listing requirements and ensures corporate disclosure and transparency for public listed companies. During financial due diligence, there are several ethical challenges that may arise. The first is conflict of interest. This happens when the advisor has a personal or financial interest that may affect their judgment. The second is confidential risk. Sensitive company information must be protected, and not disclosed to unauthorized parties. The third is client pressure to hide findings. Sometimes clients may pressure advisors to ignore or hide negative information. And lastly, there is a bias and lack of professional skepticism. Advisors must remain objective and not blindly accept information without proper verification. To handle these ethical issues, several steps can be taken. The first is advisors must maintain independence and objectivity at all times. They should not let personal interest influence their decisions. Second, they must follow professional ethics standards and ensure confidentiality of all information. Third, conducting conflicts checks is important before accepting any engagement. This helps identify any potential conflicts early. And finally, strong documentations and review process should be implemented. This ensures transparency, accountability, and accuracy in the work performed. That's all for me. Thank you.